All right, on today's show, we are going to be talking about the inflation report on Friday, the PCE. It was not great, even though we did see yields fall. We're going to talk about that. We'll also be discussing the busy week ahead. It is jobs week. We got a Fed decision and housing data. And then Nick Timiraos had a piece in the Wall Street Journal this weekend who says the days of ultra low rates are over. We're going to get to all of it. But first, the disclaimer.
Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with a 5 o'clock shadow and with the NMLS number 2028-201. He is a gentleman. He is a scholar. He is
Tyler Crawley.
I like starting the podcast out that way. Kind of different. Hook you right from the beginning. That's what it's all about in the podcast. Well, it's all about any audio world, in all honesty, but all I care about is podcasting. So welcome, everyone, to the Monday edition of the Markets and Mortgages podcast. I am the aforementioned host of this podcast, Tyler Crawley, and yeah, we have a lot to get to for a Monday show. Monday shows are either way too much or nothing. And in this case, obviously, it is the former because we have a busy week ahead. We got a big inflation report that came out on Friday. And then we got to talk about this Nick Timiraos article. The Fed Whisperer wrote this weekend in the Wall Street Journal that the days of the ultra low rates are over. So we're going to start with inflation data. On Friday, PCE, the Fed's preferred inflation gauge, well, their report came out for the month of March, and as I accurately predicted, I like to point that out because I make so many predictions, and so many of them are wrong, that when I get something right, you better believe I'm going to talk about it. And I said it was going to be hot, and that was not a I wasn't the only one saying that. I mean, the CPI report last month was hot, or earlier in the month was hot. The GDP data showed that inflation was hot. So it made sense that the PCE was probably going to show that. And it did, kinda. So the month over month data was actually spot on. The top line number, the everything index rose 0.3% as they were expecting. But what they did not expect is what was going to happen to that year over year data. So even though they were right about the month over month, the year over year showed that consumer prices rose to 2.8%. That was a big jump. They were expecting a slight increase to 2.6%. They didn't get that. So we have a hotter year over year data. This is the hottest number since November of 23. Core prices exactly the same. However, in this case, we saw a correct 0.3% rise month over month. That was true. However, in this case, the slowdown that they were expecting, so the top line number, they were expecting a slight increase. With the core data, they were expecting a slight drop, and instead they didn't get one at all. It was supposed to fall 2 percentage points to 2.6%. It held at 2.8%. So it was not a good inflation report by any stretch of the imagination. You couldn't spin this positively. Maybe the month over month data was correct, but the year over year data is problematic. And then compounding the problem was spending and income. Because we know, right? I mean, you hate to say it, but what you want to see is income slowing and spending slowing. You want to see cooling in the economy, and that is not what we got in March. Personal spending surged 0.8%. They were expecting a 0.6% increase, and income rose by 0.5%. They were expecting a 0.3% increase. So if you think about that, we're looking at spending increasing on an annualized rate of almost 10%. We're expecting incomes are rising at almost 4%. That is not that's not data that's going to give us an indication that inflation is slowing. In fact, that shows us that the consumer market continues to remain very hot. And that was not my analysis. I mean, it was, but it wasn't just my analysis. Bloomberg's Lisa Abramowitz tweeting about the reacceleration of inflation over the past 3 months, and Jason Furman, the former economic advisor to President Obama, so it's not exactly like he's not rooting for good numbers for Joe Biden's sake. He highlighted the worrying trend in core PCE inflation rates. Everyone basically saying that there is no indication that inflation is slowing. And in fact, Abramowitz tweeted that it's pretty much proof that that inflation is accelerating. So not good. Not good. That is not good data. But here's what's weird is that we actually got bond yields fell. So people were buying treasuries on Friday. I couldn't tell you why. I'm going to assume that traders maybe overreacted to the data that we got on Thursday. That was the GDP data, and they just oversold bonds. And they kind of were like, maybe we jumped the gun on that. Like, sure, inflation's reaccelerating, but it doesn't seem like we're going back to the, oh my gosh, are we going to see hyperinflation type situation that we were at, what, a year, 2 years ago? It just looks like inflation's going to remain stickier than what we would like. And we really know what one of the big factors is. That's true in the PCE data, CPI data, whatever you're looking at. It's housing. And so we're in this like weird place where the higher rates, which are supposed to cool inflation, is actually in a way making inflation worse because it's increasing how much it costs to own a home, right? And so unless prices are falling, now if home prices are falling while rates are going up, then you don't see any increase, right? It's net. They cancel each other out, but we're not seeing that. We're seeing home prices not only not fall, they're actually increasing along with higher rates. So we're in a because there's no supply out there. I mean, sure, you've seen some of the reports that have come out recently. I think Redfin had a report that we're seeing an increase in inventory in Florida and Texas, but really it's just like certain markets in those states. Like, where did I see? Was it Orlando? Maybe it was Tampa. There's a couple places where we were seeing an increase in Florida. And then in Texas, we've seen an increase in supply in Austin and maybe some other areas. But overall, even the data on the states is showing home prices increasing. Maybe not as much as other states, but they are increasing. And so this is the big problem that the Fed has to deal with. Because not to give... I don't want to give Stephanie Kelton any credit, the crazy, what is it called? Modern monetary theory. This idea that we can, just borrow as much money as we want. It's never going to be a problem. And she likes to kind of be like, oh, see, look, I told you that raising rates could actually make inflation worse. It's true for this one particular category, which is housing. But I think if we get to a certain point, that's not going to be the case. At some point, you are going to see something break. I'm not talking about a crash, but at some point you are going to see, even if there is no inflation, if rates get to a certain level, demand's just going to collapse. So even with the limited inventory, you would still possibly see prices fall a little bit. That would inevitably happen. I mean, it would have to happen. But the problem is that we have so many people who are sitting on great rates and they're like, why would I sell my house? Unless it's like some sort of life event. Like they just need more space for their kids. I think we talked about that, or I read about that recently in the Journal. I think it was last weekend. They were talking about there are people who are selling. They are selling because they have to. They're like, all right, I need more space. We've had a kid or maybe two kids since we, refinanced and got this house, and we need more space, or vice versa. There are older couples who don't need as big of a house. They saw no real reason to move, but now let's say they all want to, they want to be on one floor. They don't want to be walking up and down steps, or people move for a job or whatever it may be. So life events are still going to cause people to move, but if you don't have to, you're not going to. And the higher rates go, the more you're going to find reasons not to maybe buy that home. And so that is one of the tricky things that Powell and the markets are trying to deal with, because it is amazing. I mean, what do we see? 6%, 5%. I think it was between 4 and 5% home price appreciation nationally. And we'll get that data this week from Case-Shiller. They'll show us where we are, but it's around there between 4 and 6% year over year. And it's crazy because demand has 30-year low, and it's because of supply. That's simple. Demand has fallen, yes, but supply has not increased to put that downward pressure on prices. However, I will say this, looking at the Wilmington market following kind of sales, it does seem like you've seen a lot of people who are winning by bidding under ask. And it's not a huge amount. I mean, it's like, $5,000 on a $400,000 property. So nothing huge, but I am seeing a lot of that on that side, that people are winning bids with under ask prices. And so maybe you are seeing a little downward pressure on prices, at least for right now. Nothing huge, like I said, nothing gigantic, but it is interesting. And speaking of interesting, Nick Timiraos this weekend. Nick Timiraos, of course, the Wall Street Journal, also known as the Fed Whisperer. He's got, I wouldn't say he has his ear. Powell has his ear. I was not going to say he doesn't have the Fed's ear. He's not giving them advice. They're kind of telegraphing what they're going to be doing. And his headline was, even if the Fed cuts, the days of ultra low rates are over. And he says for the last 40 years, especially after 2008, economists and Fed policymakers steadily revised down their estimates of neutral. The neutral rate, that is. The neutral rate of interest that keeps the demand and supply of savings in equilibrium. The view became embedded in bond yields, mortgage rates, equity prices, and countless other assets. But now, some see reasons for neutral rising with the potential to change a wide range of asset prices. Then he gets kind of a little into the weeds about, how you figure all of that out. Now, he does point out that not everyone is sold on this idea. I got to find it here. He says, well, I can't find it, but there's somewhere in here where some people say, here it is. Others are skeptical that neutral is rising. New York Fed President John Williams, who co-wrote a widely followed model of R-Star, has said he expects an aging global workforce that boosts savings to keep neutral low. So he's not saying, we're going to see a huge spike potentially, but anyone who thinks that we're going to go back to, well, definitely not where we were during the pandemic, but even a little bit before the pandemic, it's unlikely that the days of ultra low rates are over. And if he's writing it, he's got to be hearing something from other Fed officials, just like overall. So sure, I mean, he quotes one of the Fed presidents, Williams, and says, so there's a little disagreement on where neutral may be, but the ultra low over. And the fact that he's writing that, someone who his ear has the Fed, I think is kind of important. Hence our discussion of it here on the podcast. It, of course, will be in the show notes, so you can go and check it out. So I mentioned it's a busy week. We got a lot going on. Monday, of course, nothing going on. As always, nothing going on Monday. However, on Tuesday, we're getting inflation data from Europe. Always, good to know what's happening globally, especially in big markets like the Euro area. However, the big report on Tuesday will be the Case-Shiller Home Price Index, which is expected to show the 20-city index increasing almost 7%, 6.7%. So remember earlier I said between 4 and 6? I was wrong. It's between 4 and 7. Or 6 and 7, I should say. But that's what they're expecting. Have to wonder if maybe they're a little overly confident, like with what we just talked about with rates. But now, pull back. I always forget Case-Shiller is crazy lag. There's a crazy lag. They're looking at February. So here we are in April. So they're a little behind. So they haven't really priced in the recent, because remember in February is when rates started going back up. We bottomed in January, then they started going back up. So we got a little time before the Case-Shiller reflects what's currently happening. Wednesday is when we start getting the jobs data, because it is jobs week. Private payrolls, job openings are expected to have fallen to 8.72 million. We got ISM manufacturing, we got construction spending, and then the big report, or more the big press conference and press release from the Federal Open Market Committee, aka the Federal Reserve. Everyone's expecting to hold rates at 5.5% for the sixth consecutive meeting. But the question is, what is Powell going to say about future rate cuts? And with what they're seeing with inflation data, are they putting hikes back on the table? Powell, was it 2 meetings ago, really kind of said no more hikes. Are they now maybe might increase that now? So Wednesday's a big day. I think what I'm probably going to end up doing, we'll do a show for Wednesday, and I'm actually going out of town Thursday and Friday, but it's not till late Thursday. So I might be able to do a show Wednesday and Thursday, and then we won't have one for Friday. So I'm thinking that's what I'm going to be doing. Thursday, we get a little reprieve, just jobless claims, trade deficit, and then mortgage rates. And then Friday's the big day, non-farm payroll. We're expecting the economy to add 210,000 jobs in April, and unemployment holding at 3.8%. It's going to be a busy week. So get ready. Enjoy today where we have nothing. Enjoy today. It's going to be a big week. So get ready for it. All right. I am ready. We'll be back here Wednesday morning for another edition of Markets and Mortgages. And remember, as always, do not wait to buy real estate. You buy real estate and wait.